We are looking at a mixed picture at the open. The Dow and S&P 500 moving slightly to the upside, still just above the flat line. You've got the Dow up just around 168. The NASDAQ, though, under a bit of pressure. Let's take a look at where big banks are trading after their third quarter results kicking off. You've also, actually, both are in positive territory. Now, JP Morgan up nearly 4%. You've also got gains at Wells Fargo up just about 5%. Third quarter earnings season is now underway, and we've got more banks on deck next week. We'll also see results from Johnson & Johnson and United Airlines. We'll get the first glimpse here for chip companies, ASML and Taiwan Semiconductors, and of course, the streaming giant and Netflix. Certainly there is a lot on tap. So here to discuss third quarter earnings season and the markets, we want to bring in Drew Pettit. He's a U.S. equity strategist at Citi. And Drew, I think if we just take a step back, not so much focusing on the results that we're getting out this morning, but more so the expectations for this earnings season. And I think after this massive run up that we've seen, do you expect to get that historical traditional bump that we normally get at earnings season, or will it likely be maybe a more muted reaction this time around?
So let's decompose this a little bit. Reaction, potentially more muted, especially for the growth side of the market, maybe not the value side of the market. And then as for like the actual results, we think they're going to be better than normal. Look, we're in the U.S., beats are normal. That happens every quarter. But we actually think this earnings season is going to be better than what we typically see. The offset is, and again, this is also normal, Q4 estimates normally come down. Right. We just think they come down a little bit less than what's normal.
And so that's what I was going to ask. Better than normal by what metric? Because if it's forecast, then certainly you would expect that many names would be able to rally on the back of if there were enough big, large companies coming out and saying, hey, the economy is a little more resilient than we had expected, and we're either reiterating or raising our forecast, then that would potentially be looked at as a rising tide. Is that something you're expecting, or is it more so?
Actually, no.
Okay.
Sorry to cut you off.
No.
But no, we're not expecting that because you still have an election, you still have geopolitical concerns. And I don't know if we're completely out of the woods yet with Fed trajectory and macro data and so on. And you're talking about all these companies that have really high valuations. This is a great time for a CEO to just kind of level set a little bit, get the bar moved a little bit lower. And then what we're comparing to is we're looking at long-term analyst trends. We looked at 20 years of history. Almost every single year, Q4 numbers come down as Q3 numbers are being reported. So this time, likely not different, but a lot of good news priced in.
Drew, you mentioned the fact that we might not be out of the woods just yet. What is most worrisome to you at this point?
If you look at the manufacturing side short term, and you look at a lot of what our economists are talking about, you still have those PMIs that are sub 50, industrial production's just kind of hovering around zero. You're just not sure what's going to reignite things. The good news is the Fed started a cutting cycle, or we think they did. So people are willing to kind of look beyond maybe the next few months and start looking into 2025. But again, not quite out of the woods on the economic side.